Good morning, good morning, good morning. I hope everybody can hear me okay on this Monday, March 20th. My name is Adam Kahn, and this is my half-ass channel here in Las Vegas, where, oh my God, I can't believe how much rain we're getting this year. It's kind of weird, and it's cold. I gotta wear a jacket in the middle of March, which I moved here to wear shorts year-round, not because I thought it would get cold. And I used to do that. But as your blood gets used to the warmer weather, it's amazing how I get cold in temperatures that used to be nice to me. But to be fair, it's pretty cold and it's overcast, has been a lot lately. So, those of you who don't know me, I am not a financial planner, I'm not an accountant, and I'm not a lawyer. Just a guy who shares some information. Please use any of the information on this channel for entertainment purposes only, and reach out to your financial planner, your lawyer, or your accountant for any financial decisions you make. So now that I got that out of the way, let's talk about all these gloom and doomers talking about housing falling 30, 40, 50% from here, the stock market crashing, and. Well, as a trader, what you look for is things that don't make sense. Exceptionally bad news, where markets aren't continuing lower, and exceptionally good news where a market isn't going higher. And when people are fearful, that's when you're supposed to get greedy. And when people are excited and greedy, that's when you should be fearful. Well, just using psychology, people are pretty scared right now. Fed's raising rates. We've had some bank closures and failures that people don't really understand. They're nervous that their money isn't safe. They see credit card debt going up, savings going down, announcements of big companies letting people go, and the market's up 37 handles for the S&Ps last I looked, as well as everything else looking okay. You know, I've gotten into the mortgage industry years ago, and I'm seeing the volume pick up there too. And the people who are talking about the data that they're seeing, usually the information they have is flawed. You know, how many more homes there are today versus a year ago type of stuff. Well, our inventory was exceptionally low, where people were scared that that was a major problem. And in terms of the average of where it's been, at least in Las Vegas, for the past few years, despite it being 3, 4, 5 times more than what it was when there was like none available, it's still less than a typical market. So I'm not really sure why they point out the percentage increase as some like monstrous change that looks like we've got a ton of inventory when I still see an inventory shortage. You know, we could still use some more inventory to make it a healthy market. So this increase that they point to of inventory is silly. On top of it, they don't seem to have any understanding of how the loans were working, and that no matter what happened last time isn't what you're going to see again. So I don't even understand it. Most of the data they point to is information that everybody else has. So if the markets are scared, that's who I want to buy from. The only disconnect for me is the prices look high, but so does a loaf of bread and so does everything else. And most people seem to be adjusting to it. The ones that really bother me the most are people who are realtors saying this, because I think they're doing a disservice to their clients and the industry. Let go of your real estate license if you don't think people should buy. I don't mean that sarcastically. Why are you a realtor? Like, really? Why are you a realtor if you're telling people don't buy a house? Go be a market analysis guy. Maybe you're right, maybe you're wrong. but you sure shouldn't be helping people buy homes if you're telling them not to. Just doesn't. It's a disconnect. Now, I'll admit that this past November, December, and January, even as a lender, I started getting uncomfortable doing loans just because I was uncomfortable with what the market looked like. But now that prices have come down 15% and people are scared, well, what are you waiting for? Really, most people looking to buy a home, if you're looking to buy a primary residence, shouldn't even pay attention to a lot of this. You should work on saving money, coming up with a budget, and staying in your budget the same way you would for a car or anything else. And maybe talk to somebody who helps with your finances to make sure you're within reason. But then whatever the market is today is what the market is. Don't get so angry about it. Like, I'm listening to one comment where he said to me, well, a year and a half or 2 years ago, my client qualified for 500,000, and now with the higher interest rates, they only qualify for 350. And my thought is, so, like, what am I missing? That happens. I wanted to buy Amazon at $30 a share. I didn't. It's now higher. Well, sure, I could wait for it to go back, but maybe it never does. And while I'm waiting, I just miss out. I think that's the same with the houses. If the sellers are panicked and selling and now giving concessions, well, I'd want to be the buyer. Good opportunities. Until something changes where everybody just thinks the market's going to go up and up and up again, I'd sit and wait. If there becomes a scenario in the next whatever timeline it is where everybody's over optimistic again, well, sure, I'd look to sell some things. But while everybody's scared, if I have the ability to hold on or buy more, this is a perfect opportunity. If you have it set up where monthly payments go into a mutual fund, this is when you make your average better because you're buying them cheaper. If you're letting the people scare you out now when prices are better and only buying when everybody thinks it's going higher, odds are you're going to constantly be buying the tops, listening to people who are watching the media and not paying attention to the price action. They get really excited at the tops, they get really excited at the bottoms, and they talk about how it's going to keep going. I think they just get a little oversensitive to the news and what's going on. Look, we went hiking yesterday, then we went to lunch, then we went to Costco. I know it's a weekend, but when I say the places that we went to were busy, they were busy, like really busy. Up hiking, there was barely any parking. The restaurant was busy to where it was a little bit slow. Everybody was very polite, but it was a little bit slow to get our orders. And then we went to Costco where, oh my God, they were slammed. Again, I know it was the weekend, but to me, that is not a struggling economy that's going to have a big collapse. So, what are you guys looking at? You're looking at data that's telling you what's already happened. And we've already corrected on pricing, and the market's holding up okay. The job losses are beginning, so I think you'll see some unemployment tick up, but there's still big demand, so I don't see it tick up to where it becomes an actual problem. My biggest concern are some of the comments that the Fed's made about only handling the banks that they see as a systemic risk. What bothers me about that is I hope that the smaller banks that are just fine don't have a bunch of depositors asking for their money to come out of them and moving their money to the big banks, because I always feel like the economy is an unfair playing field to the big companies. So when the government steps in to scare people out of the smaller companies right into the bigger ones, they make it even more unfair. Not meaning to, and I understand. I understand. Excuse me. People, the government wanting to deal with the banks that are what they call a systemic risk, but that on its own creates a panic and pushes more business to the bigger companies and out of the smaller ones, which means the bigger get stronger and the smaller get weaker, which I don't see as a really fair environment to play on. Um, you know, just my opinion on that one. But outside of their comments, and maybe that, not going to be bigger problems. What's the issue? Now that there's some panic, look around for some opportunity. Anything that's a good, strong company that's been falling recently or had a good correction, maybe it's an opportunity to buy some good stocks. You know, I see Google and Amazon and well, Meta's had a nice run, but Disney and Starbucks and a lot of these companies, a lot of them, not just the ones I mentioned, have had nice pullbacks. So the ones that you watch that have fallen really far and now they're beginning to go back up when you're thinking, I'll wait until it feels more comfortable. Well, if you're waiting till it feels more comfortable, what I find that means is you don't want to buy it until it's at a higher price. Well, why would you want to wait until it gets more expensive and not take the opportunities while things are cheap? And if your job is fine and your income is stable and you consistently save money and it happens to go lower for a little while longer, well, maybe you can just buy more cheaper. I don't really worry, maybe incorrectly, that Google's going out of business or Microsoft. So I think they're well-run companies. So I put money into them. If they go lower, I look to put more in, unless something fundamentally in my brain changes about those companies. I think they weather the storm better because they have the advantage of, if the government sees it as a systemic risk when they run into problems, that they have that support. They also have the ability to maneuver through good times and bad times differently than small mom and pop places. I wouldn't be surprised to see more fallout, but on the smaller companies and the ones that have been tight to begin with. The banks might get tougher about their lending and not make the money as easy. So if you're a small pizza shop that's using a line of credit, your rates went up and they might be a little bit tougher about the borrowing now. You might get squeezed out, but that doesn't mean the economy's collapsing. I know one that I pointed to that I really like is the guy who was going on and on about auto sales. The average car price going up and the interest rate going up, causing the average payment to go from 5 something to 9 something, and blah, blah, blah. And all I kept thinking is, well, when you buy a car, it's not an adjustable rate. So it's not like you went home and you now have your $580 payment and whoa, you're all surprised because 1 month it's 900 because rates have been going up. It doesn't work like that. These are fixed rate loans. So whatever your payment is your payment. And if, let's call an Accord an average car, if the monthly payment on Accord went from 5 and change to 9 and change, and you can't afford 9 and change, I'm guessing you just look for a different car if you're in the market and need a car. I don't think that means you don't buy one. So the industry still gets its sale. The economy still moves along. People adjust. They have to, whether they're happy about it or not. Uh, why would that mean that the stocks are going to collapse or the housing or anything else? Commercial real estate has some issues as loans mature because a lot of those are shorter durations, and oftentimes they refinance afterwards, especially if they're one of the companies that uses cash flow to be able to buy more and more properties. As interest rates go up, that's going to limit their buying power. But similarly, unless they're just a little too leveraged and pushing the envelope too far, they just adjust also. And if they're too leveraged and pushing the envelope too far, well, that's the fallout that the Fed was looking for. I guess we'll see how it plays out. But please, don't listen to these guys. Like, if you're looking to buy your family a home and change from being a renter to an owner, my God, don't let some YouTube guy scare you from doing that. If the house prices go down and you can afford your payments, well, that just puts you in a better position to buy a bigger one down the road, because as a percentage, they should move in the same amount. So a more expensive one might become more affordable. The interesting thing is, if the bank fallout causes the Fed to stop raising rates, you'll see interest rates come down. I mean, they already did at the end of last week, and going forward, they have a lot of room. So a typical spread between the 10-year and a mortgage is usually about 1.75 points. Well, it's stretched to 2.5 or 2 to 2.5 plenty of times recently. And I think that's the concern of how far the Fed might go, and the banks padding that out of concern to price it in already. Well, if the Fed's done or close to it, even if rates stay here, you should see the mortgage rates come down a good 0.5 point or so, and cost, just because that spread has gone up so much. As the banks get more comfortable that maybe they don't raise, they won't need that extra cushion in there. Now, to be fair, as somebody in the industry, as much as I hate this idea, part of me thought if they need to fund some things, they can add different charges into the mortgages to help pay for it. I hate that concept out of selfishness, but the reality is, if there's enough demand for mortgages at 6 and 7%, there really is no reason not to sell them there, even if the bonds come down, and then use that to help support the economy. Again, not what I would want, but I see it as a viable option that they could look at. I don't think they will. I don't think they'll see that as an available tool. I just one of my own. It's easy to talk as an outsider as to what you think the Fed and the other people should do. They have a lot of things to worry about, and they're stuck in a bit of a corner, because what I was getting at there, sorry, let me just press the crosswalk, is if they have to stop raising and mortgage rates go down, well, it's very possible that we'll see the prices start to go up again, despite everybody feeling like it's expensive. People base their payments or their purchase on their monthly payment. Well, lower rates, lower payment, typically that means prices go up. If the Fed's trying not to allow the real estate market to go higher, but they need to save the economy, it's a tough position to be in. I don't really envy it. Everybody's a little bit tough on them, but they have a lot of things on their plate to look at. So anyway, hopefully you enjoy the video. Thumbs up, like, subscribe, argue with me. I'm happy to take the other side. If you disagree, like, quite honestly, if I hear good points, I'm okay. Like, I can be swayed. My trouble is all the videos I'm watching are people touting numbers that everybody's well aware of. You know, if the big money index shows that they have sold more than usual, corporate buybacks are the lowest they've been in a long time, and investment money has also been decreased huge and is at the lowest amount, and the stock market is drifting or going higher, somebody's taken the other side of that panic. I'm just a small guy, but I want to be part of the people taking the other side of the panic. I don't know. If everyone else wants to be part of the panic, maybe they'll drive it lower for everybody who doesn't panic with them. If we don't have a, a depression like the 1920s, well, everybody will be surprised when things just continue along like they have year in and year out. So, hopefully, you like the content. Since my wife doesn't want to hear me talk, I get to talk to myself on my walks. So, enjoy your week. I'm sure I'll continue to post throughout the week. Keep an eye out for my shorter videos too if you don't like listening for 20 minutes. Have a great day.